Okay, so good morning, all. It's great to meet again. Uh, we we were doing for the last two meetings, I guess, we have been working on this topic of how the taxation can have an impact on the company's valuation. So basically, we have been discussing how the company's financing have an impact on the company's value. This is very revolutionary idea because hitherto, and if you look at the classics, the classic economist, they would always say that it's not the financing side which has any contribution to the firm value. It's only the asset side. So that's a backdrop. And in this backdrop, you will be required to do task 8. We move a little bit further now. And the topic that we shall discuss today mainly, which I shall try to go a little bit further, but the main emphasis of today's topic is homemade leverage. It's like homemade cheese or homemade wine or whatever. So this leverage is also homemade. Before I discuss this topic, the technical intricacies, I want to discuss the backdrop of this topic. Imagine you are an investor of a company and you have invested in the company's stocks. You have the shares of a company. Let's name the company. Let's imagine you have British Petroleum you invested in and you are a shareholder. Maybe you have only 100 shares or whatever, that doesn't matter. The BP, the company, decides to borrow more or borrow less, whatever decision it makes, it will have an impact on your cash flows as well. How? Because we know that we studied in the previous topic that when the company is going for more leverage, there is a debt tax shield. So it means that the company's cash flow would be affected by the choice of its capital structure. And this will affect, in turn, the investor's capital structure, your capital structure. The question is that how come the individual people have the capital structure? Of course they have. When you choose to invest in a company, you either invest from your own pocket, maybe your savings, or sometimes you borrow from the bank so that you can invest in the stocks. And if you borrow from the bank or some friend or a relative, that is called the debt. So like companies, debt and equity can be seen in its liability side of the balance sheet. Your capital structure, the one individual, I'm making it more extreme example that somebody who's working in a company is a marketing agent or an accountant. The person gets some salary, let's say 4,000 euros a month. The person has some savings, let's say 700 euros a month, and then this fellow decides to invest in the stocks. So when this person is planning to invest in BP, the British Petroleum Company, it would look at its past savings, which I would call as this investor, this individual's equity. Maybe this person has 6,000 of his past savings, which can be referred as equity. But this person has a target to invest 10,000 euros in the stocks. And then this guy may decide to borrow 4,000 from a bank or somebody, some friends or whosoever. So 6,000 is this person's equity and 4,000 is debt. Therefore, like BP has its debt to equity ratio, in the same fashion, this investor would be having a debt to equity ratio. His own homemade debt to equity ratio would be 4,000 of debt and 6,000 of equity. 4 divided by 6 to 0.67. In other words, this person's debt to equity ratio is 0.67, which means that for every 3 euros of equity, this person has 2 euros of debt. Like the company have debt to equity. And when the company changes its debt to equity ratio, don't think that this investor's cash flow would be unaffected. They will be affected. A smart investor would make a change in correspondence, in accordance with the change in the company's equity, debt to equity ratio. So when the company changes its leverage, it will affect the investor, and the shrewd investor, the smart investor, would make a change in his or her own homemade capital structure, the homemade leverage. Okay, so that you are able to offset the impact caused by the company upon your cash flows. So once again, when the company makes a change in its debt to equity ratio called leverage, you as an individual investor will not remain immune to it. You will be affected. But then what you should do, you should make a similar change in your capital structure so that you are able to absorb the shock. Shock of what? The shock of change in the capital structure started by the company. This is the backdrop of homemade leverage. The word homemade is attached because this is done by some household people, some ordinary common people, so they also make the change in their own personal leverage, as I said. Okay, so that's what we do in this topic. I will not read from the slide, but basic idea is that it's like a change in your personal leverage. So you make some substitutions in your personal leverage. Example one of homemade leverage. The movement away from debt to equity. You are an investor. You invested already in a company. So you are a shareholder of a company. Let's go step by step. The company has a debt also, of course. But now the company decides that, hey, you know what? We don't like debt anymore. Let's move away from debt and replace debt by the equity. In other words, the company you invested in has done already, just recently, or is planning to do a movement from debt to equity. So reducing their leverage ratio. The company want to have less debt and fill the gap with more equity. That's the situation. How would you be affected? And if you are affected, would you be a silent spectator and looking at the mercy of the company, what they're doing? No. Or are you smart enough that you can also make some changes in your homemade leverage or the personal leverage so that you are able to have the same cash flows, if not more, than before? Okay, let's see the situation. The situation is that when the company is going to make this change, at that time, the interest rate on debt in the market is 5%. And we assume that the individual person and the company both borrow at same 5% rate of interest. It's an assumption, but we can give it up. It's not a big deal. The EBIT for the firm is $50,000, which means that the company which has, when the company is, when the company has this operating profit, it's $50,000. The earnings before interest and tax, and we ignore taxes. So that's a very big assumption, ignoring taxes. If you remember, I wish you remember, when we were discussing, when we were trying to refute or trying to disagree with Modigliani and Miller in the last lecture, we saw that it's a tax which makes the difference between, so we generated some debt tax shield. First we generated the interest tax shield. That tax shield would not have been generated if there was no tax. So in the assumption of no tax, Modigliani and Miller would be right. And here again, we are assuming for the time being that the taxes do not exist. And whatever profits we have, what we have $50,000 as EBIT. All this money, all the profit the company has would be distributed to the shareholders. That's why we say the dividend payout ratio, which means that all the profits would be distributed in the form of dividends after making adjustments. So the company used to be levered L, 50% equity, 50% debt, as you can see here. But now the company is moving away to become a unlevered company. So basically, they are going to have the debt to equity ratio. They used to have 1, but they plan to have 0. So basically no debt. So how you would be affected? And do we assume something else? No, we don't assume anything else. Okay. So before I do the calculation, I want to ask you, do you understand the background of this example? Case 1, I, the person, or you, the investor, already have 10,000 invested. So your investment is 10,000 in the company. It means that when you put your money in the company, you invested 10,000 in the company's equity. And at that time, company was having debt. So the company was this L, levered company, you can see here. So the company has equity 100,000, debt 100,000. And how much money you invested in the company? 10,000. 10,000 is 10% of equity. In other words, you are the owner of 10% of the company shares. Make sense? Now, if you own 10% of the company share, what do you get from the company? Okay, let's see. The company's EBIT, the profit before interest and tax, was 50,000. It's mentioned here. Here. The rate of interest is 5%. And we all know that before the equity shareholders are paid, the company makes payment to its debt holders. The finance cost comes before the dividend, the net profit which goes to the shareholders. It means that the company has borrowed 100,000 debt. The rate of interest is 5%. So if you, if you apply 5% on 10,000, 100,000, it comes to be 5,000. 5% rate of interest on 100,000 of debt. It comes to be 5,000. And we know that from operating profit, we minus finance cost, and then comes the gross profit. So when you minus 5,000 from 50,000, it comes to be 45,000. This is the money which belongs to the shareholders. And we assume here that there is no tax. Otherwise, this 45,000 is the profit before tax, then you pay tax, and then it's profit after tax. But here, we assume that there is no tax. We keep a simple life. This 45,000 is available for the shareholders. The question is that how much money will go to the shareholders? Well, we have one more assumption, rather a statement, that dividend payout rate is 100%. It means that whatever profit is left with the company, it goes exclusively to the shareholders. Company doesn't keep any money with itself. So it means that all the 45,000 would be paid out to the investors. Since the investor in this question is owning 10% of the company, of the equity, in other words, the investor would also get 10% of 45,000. 10% of 45,000 is 4,500. In other words, you invested $10,000 in the company's shares, and in turn, you get 4,500. So you invest 10,000 and you get the share of profit 4,500. In other words, the return on investment is 45%. So you as an investor have earned 45%. This is the situation before the company move away from levered to unlevered. Okay, remember that this is the situation when the company was levered. Now what happens? Case 2, company wants to retire all its debt. The company say that this debt of 100,000, which is here, we don't want it, and instead we want to make equity. So equal amount of debt would be replaced by more equity, so that the equity would be 100,000 existing plus the equity replacing more equity replacing debt 100,000, so that the equity altogether become 200,000. So we are moving away from this L levered situation to U, the unlevered situation. When it happens, you still have $10,000 in the company's equity. The company has no debt now because it's unlevered company. When there's no debt, the company will pay no interest because there's no debt. It means that all the $50,000, which is the EBIT, the operating profit, is available for the shareholders. So because there's no debt, there's no interest. Last time, when there was debt, when the company was levered, the operating profit was still 50,000, but then we subtracted 5% of $100,000, which was the interest rate on debt. So you subtracted the finance cost, 5,000. So the profit for shareholders was left with worth 45,000. But now this situation is not existing. There's no debt. When there's no debt, no interest. So all the 50,000 is available for the shareholders. But you know what? You are affected unfavorably in this situation. How? Earlier, you were having 10,000 shares, which you still have, and the total equity was 100,000. In other words, you were owning 10% of equity because 10,000 is 10% of 100,000. But now the total shares are 200,000. 200,000 means your denominator is not 100,000 but 200,000. And since your investment is 10,000, 10,000 are 5% of 200,000. So in other words, you would get only 5% of the profit. Now 5% of 50,000 is 2,500. 2,500. You invest 10,000 and what you get? 2,500. Your return on investment is 25%. It used to be 45%. But now when the company has retired its debt and it's all equity, your return on investment has come down from 45% to 25%. So you can see here that you used to earn 45% when the company was having debt, but now without debt, when the company is all levered, the company, you are only getting basically 5,000. And 5,000, what you get is basically 10% of the profits. 10% of the profits. No, I'm confusing it. Yeah, so 10,000 you invested, and 10,000 is 5% of the equity now. And what you get is 5% of the profits, and the 5% of the profits is 2,500. In other words, you only get 25% of return on investment. The question is, what should you do that you regain the 45% which you used to earn before the company made this change? Okay, you are a smart investor. You will not settle for less. And you see that why your 45%, why it's so that your return on investment has fallen from 45% to 25%. You realize that when the company was having more debt, you were earning more. And now the company is having less debt. You are earning less. You cannot force the company to borrow more because you're a small investor. You're only a fraction of investment. You cannot force the company to borrow more and go back to the good old times when you were earning 45%. But what you can do is that you can borrow more for yourself. What you do, you want to regain this 10% of the total equity. Previously, when the company was having 100,000 of equity and you invested 10,000 in the company, you were owning 10% of shares. But now, because the company is all equity financed and you still have 10,000 investment, which makes your share of investment only 5%. And that's a problem. We need to raise this 5% back to 10%. How can you make 5% to 10%? What you can do is, you need to figure out in your head that now the company's total equity is 200,000. What is the 10% of 200,000? 10% of the 200,000 is 20,000. But you have only $10,000 in your pocket. But hey, no problem, borrow. You the investor, borrow personally from some bank. You go to bank and you ask for a loan of $10,000, and the bank will charge 5% rate of interest from you because the rate of interest is 5%. Now you have 10,000, your own money, this is your equity, and then you borrow 10,000 debt from the bank so that your total investment in the company is 20,000. Now 20,000 is 10%. This is what we wanted. And now you have, again, total shares in the company equal to 10%. Now you will be owning 10% of the profit. And 10% of the profit is $5,000. That's what you get from the company. But don't forget that you also borrow from the bank. How much money you borrow from the bank? You borrowed 5%. You borrowed $10,000 from the bank. And at what rate of interest? 5% rate of interest. Take this money back, give this money back to the bank. So 5,000 you get from the company, and 5% on 10,000 you give back to the bank. You are left with 4,500. And here I was a little bit sarcastic and I said, have you seen it before? Yes, we saw it before. This is the same 4,500 which you used to earn in the good old times when the company was having debt. And guess what? What is your return on investment now? What is the return on your equity? The rate of return on equity is 4,500. You invested 10,000 in the company. Okay, the 4,500 is the money you get from the company, and you are getting 45% back. So basically, you have got 45% money back from the company, which is same as before. When the company made this change, they didn't take into account your interest. Your interests are unfavorably impacted. But since you're a smart investor, you can make some changes in your homemade leverage This is the homemade leverage. The debt to equity ratio of the company used to be 1, you can see here, before the change, but after change, it has become 0. But you personally, in your own capacity, are able to maintain your debt to equity ratio equal to 1. How? 10,000, the same amount of money which was earlier. You can call it your equity, the personal equity, and then 10,000 you borrow from the bank, so that altogether you invest 20,000 in the company's equity. You invest 20,000. Okay, out of this 10,000 is debt, 10,000 is your equity, and you are able to get the same amount of money which you used to get from the company before. This is the beauty of homemade leverage, because after this change, your cash flows were shrunk to 2,500. But now you are still able to get 4,500 from the bank. This is smart investment, and this is homemade leverage. Okay, so the same example I've done with the calculation here in Excel. And you can see that the company where this shareholder X, his name is X, invested, and this shareholder, by the way, invested 10,000 amount. The company's equity used to be 100,000. The book value, the debt used to be 10,000. So that the firm value was the 200,000. But now the company has moved away before and after. The company has become now unlevered. So that this 10,000 debt is offset by more equity. So there is no change in the company's book value. But see what happened. When the company was levered before situation, so I'm going in the same column, the EBIT, the operating profit used to be 50,000. The interest cost was 5% rate of interest on 100,000 of debt, which you can see here is 5% on 100,000. The profit before tax was 45,000. And since you were owning, the investor was owning 10%, so the investor would get 10,000 out of 100,000, so would get 10% of the profits, which was 4,500, and thus the rate of return on equity was 45%. Now what has happened is that the EBIT is still 50,000. The interest is no interest because there's no debt. The profit before tax is 50,000. Profit, yeah. And the share of investor is now this much. You still own 10,000 amount of wealth in the company, but this time you will not divide it by 10,000 because the equity used to be 100,000, but now equity is 200,000 because company has replaced debt with equity. Thus, you don't get 4,500, you get 2,500 from the company now. And 2,500 makes 25%. You invest 10,000, you get 2,500. The return on investment is 25%. Thus, the investor is a loser, basically, if I can say so. So in the above situation, so when firm becomes unlevered, investor X loses out. Homemade leverage will help investor X to regain 45% return on equity which he used to earn when company was levered. So I can quickly explain it to you, the whole situation, I think. So we know that the company before this change was levered, the leverage, the equity was 100,000, the debt was 100,000, the value of the company was 200,000, and the company's EBIT was 50,000. The interest cost, you can see, is 5% of 100,000. So after the company would pay the interest, the profit before tax would be 45,000, and this investor X would get 4,500 because this investor X was getting actually 10,000 investment out of 100,000. So this would be 10%, and 10% of the profit before tax would be 45%. But now something wrong has happened. Well, wrong from the, maybe not wrong from the company's point of view, but from X point of view, that company has actually deleted its all debt. So debt basically is zero now. And all the debt has been replaced by the equity. So that, but the problem is that the investor share in the company is still 10,000. That doesn't change. And now when I do this calculation, the profit before tax, sorry, the EBIT is 50,000. The interest cost is zero because there is no debt. The profit before tax is now more 5,000 because there's no, the interest paid. But the problem is that now X would get not 4,500, but 2,500 because 10,000 is not 10% of 200,000. 10,000 is only 5% of 200,000. So you get only 5% share of profit, which means that your return on equity is now 25%. This change from the company has affected the investor X unfavorably, but the investor X is a smart guy. So when he loses out, he makes the homemade leverage. And what he does, he goes to the bank and borrows additional 10,000 euros or dollars and add to its 10,000 own equity, the previous investment. So now investor is investing 20,000 in the company, okay? However, 10,000 is still debt and 10,000 is the equity. I should say 10,000 is still equity and 10,000 is debt. And now we do the recalculations. 50,000 is the company's profit before tax. The investor's share of profit is 5,000 because you are owning again 10% of the company thanks to this additional debt. And now don't forget that you have to pay interest cost on the personal debt. Here the word personal is very crucial. It's not the company's debt, it's the investor X's debt because he borrowed it. And afterward, the net cash flow is 4,500, which used to be before this change. And now, because your 10,000 is investment in the equity, the return on equity is still 45%, which used to be before, which used to be in this, the company was levered. So company was levered, the company becomes unlevered, and the company becomes unlevered. If you make no change, if you remain quiet, silent spectator, you would lose out, believe me. You can see it. What a fall, 20% point fall in the shareholders' revenue. It's a big drop, okay? But because this ex-investor is able to borrow, then he or she is able to get the same returns which he would get before. So this is the So even after change, you are able to get 45%, which you used to get before. This is the beauty of homemade leverage. And the same way, you can calculate the homemade leverage when when the company is going away from equity to debt. I didn't do any calculation. I just did some kind of symbolic things in the form of notation. But all I can say is that even if the investment in the company is going away from equity to debt, more debt, yes, you can do it, and you can make the same cash flow as before. But one thing I want to discuss with you today, and that the last subtopic for the day, is the debt capacity. We have talked about the good things about debt. We saw that the leverage generates debt tax shield. First, it generates interest tax shield. Remember the example? We were able to generate some $27.20 before, more than the unlevered company. And then we had more discussion here in the homemade leverage that the investor is able to produce more wealth, more rate of return. But now let's talk something about the potential harmful things about the leverage. And before we discuss about the harmful thing about the leverage, we must know the concept of debt capacity. Debt capacity. Every company has a debt capacity, which means what is the maximum capacity it's able to borrow. This capacity is very dynamic concept. It keeps changing from time to time, situation to situation. I think I posted one article of ours, me and my co-authors in the Optima. You can see it, and there we discussed that how the debt capacity of the Nordic companies, how it used to be before the 2007 financial crisis, how it changed during the 2007 crisis, and how it re-emerged in 2011 when the crisis was over. So the same company's debt capacity can change from time to time and situation to situation. When it's a recession time, then your debt capacity shrinks. But when you are in the boom period, when it's very prosperity period, the last very prosperous time I can see when the investors were really making money was late 80s and early 90s, till mid 90s. Investors were really, the stocks were really going up. That was a really great time for investors, and a great time to become a company CFO or a CEO. So during the good time, the debt capacity goes up, but during the bad time, it goes down. The question is that what are the factors which are affecting the debt capacity? Because if your debt is beyond the debt capacity, which keeps changing, remember, it's never eternal. It keeps moving. It keeps going up and down. And if your actual leverage is more than the debt capacity, then you are inviting a problem. The wrath of the market. It's called financial distress cost. If you have your actual leverage is more than what you are capable of, if you borrow beyond that, then you are inviting a problem, and that is called financial distress cost. Financial distress cost means the probability, the chances that the company would become bankrupt goes up. So if you are overly levered, then the financial distress cost will be so big that they can totally eliminate the company, and then you don't get those debt tax shield things. Those things become absolutely useless or irrelevant at that time, because if the company doesn't exist, there's no debt tax shield, no benefit of the leverage. And if you borrow too much, then the company may actually cease to exist. So the debt capacity makes a big impact. Uh, the first reason which can have an impact on the debt capacity is that the profitability. If a company is more profitable, then you are able to borrow more, because more profitability means that you have a lot of backup. You have a lot of the financial cushion, so that in the event of crisis, you can pay out of your past accumulated profits. So a company which is more profitable, not just profitable, I would say consistently profitable, that company is able to borrow more. So that would have more debt capacity. The asset mix, the existing debt to equity ratio. If a company's debt to equity ratio is already very high, then your additional debt capacity shrinks. But if a company is already under-levered, which means the debt to equity ratio is low, then you have the potential to borrow more. Hence, your debt capacity is more. Another factor which may impact the debt capacity is the maturity level of firm. If the firm has been in the scene, in the corporate world, its life is very long. It has a history, it has a legacy, which itself is a proof that the company must have survived many rough times. A company which is for long period, which has a longer history, speaks of its steadfastness, its bravery to face the challenges. But if a company has less time, I mean, you don't have long history, then perhaps as a bank manager, I would be a little bit reluctant to give you more money because, hey, you don't have much history. But if somebody comes to me and that company is existing for the last 50 years, well, I have a reason to trust you. The company which is having more tangible assets, tangible physical assets, also have a higher debt capacity, because tangible assets are more likely to be accepted as a collateral by the banks. Because when you borrow from a bank, you give some security, you pledge some property. And if that property is a building or a tangible asset, then the bank manager is more pleased to give you loan. But if you have an intangible asset as a possible collateral, as a possible security, the bank manager would be reluctant to accept it. If you have a software and you go to the bank and say, hey, Mr. Manager, I want to borrow from you. And the manager says, do you have any security? Do you have any building or machinery or any vehicles? Say, no, I don't have them, but I have a formula. I'm working out on a software. I have this algorithm. Can I give it to you? Well, what would the manager do with that algorithm? I don't know. So the company, all else being equal, an oil company, a petroleum company would be able to have a higher debt capacity than a software company or an R&D company, because you hardly have any tangible asset which is worth, which can be used as a collateral. The debt capacity also depends upon the stage of the project. If you are in a very early stage of the project, then the banks would be more reluctant to give you any lendings, because you don't have any proven track record. Nobody knows you. So either you have your own money if you want to start a project, the internal capital, or you find some kind of angel investor or somebody who can finance your project. Okay, find some non-traditional form of funding. Okay, so you first start with the internal capital, then slowly when you prove your point, only then you are in a position to to get the funding from in the form of leverage. So when you are a newcomer, when you are a startup, your debt capacity is very less. But as you become mature, your debt capacity also keeps increasing. Okay, so these are the some points which I hope that you understand that debt capacity is a dynamic issue. Not two companies have the same debt capacity, and not one company have the same debt capacity in two different situations or two different time periods. As I said, that in the good times, your debt capacity increases, but in the bad times, your debt capacity can shrink. Okay. Plus, on top of this good time and bad time, there are some more factors like profitability, the asset mix. If you have more tangible assets, you are able to borrow more. If you have more intangible assets, you have done in the management accounting task also that you look at on the tangible and the intangible assets. Okay. If a firm has more intangible assets than all else being equal, the company would be having a lower debt capacity. And also at what stage of the project you are in, right? So these are some of the points which I think I wanted to share with you. So in the next meeting, we will finish off this remaining part of this firm leverage and valuation.